Welcome back everyone, my name is Angelo. Ever since the inflation shock in 2022, we've seen an unprecedented rise in interest rates set by central banks across the board, not only in the US, but in Europe as well, to over 4% as it stands. This caught most people, me included, completely off guard. I remember just 2 years ago I was happy that my broker wasn't passing on the costs they had to pay on my cash due to interest rates being negative at the time, which is just crazy when you think about it. Imagine you lending someone your hard-earned money and then you actually have to pay them interest. It just didn't make any sense. Luckily, the situation has changed dramatically in our favor, with interest rates in the Eurozone jumping all the way from negative 0.5% to 4% in record time. This means we're finally able to earn pretty attractive yields on our money via some of the safest investment options out there, namely bank deposits, money market funds and bonds. And that's exactly what I want to focus on today. So let's not waste any more time and start with the first option, high yield savings accounts, aka bank deposits in most cases. If your bank is not paying you any interest on your euro balance, you're basically missing out on free money right now, with your bank pocketing whatever it's earning on your cash. Now, when looking at high yield savings accounts, the first thing you should look at is security. Is the money secured by a 100,000 euro bank deposit guarantee, only up to 20,000 euros, or not at all? And in which country? And is the interest being paid by the banks themselves, or are you actually buying a fund? This is the case on Wise, for example, previously known as TransferWise. Here you can see that while the interest rate account looks interesting at first glance, with an interest rate of 3.64% on euros, Wise is actually just buying a BlackRock money market fund for you while taking a cut in fees for itself. I'd argue that's not the best option and the interest rate is not guaranteed, but at least the risk of you losing money holding the BlackRock ICS Euro Government Liquidity Fund is very small. Now, my personal #1 broker in Europe, Interactive Brokers, also pays interest on deposits, not only in euros but many other currencies as well. Sadly, the offer is not as good as it looks at first. That's because interest is not paid on the first 10,000 euros or dollars you have in your account, only on the amount beyond that. And secondly, even then you only receive the full offered interest rate if your Interactive Brokers account has a net asset value, so cash plus your assets like ETFs or stocks, of over $100,000 or euros. Otherwise, you receive a lower rate proportional to the size of the account. You can see the difference in these two examples. For high yield savings accounts, there's one option that still stands out to me 2 months after its introduction, as I haven't been able to find a better offer since. Trade Republic's 4% interest per year, secured by a 100,000 euro bank deposit guarantee, with interest being paid out at the beginning of every month. My wife and I are using this account as well to earn interest on our own cash reserves. Here's what you need to know. While Trade Republic is now available in 17 countries across Europe, for now you're sadly out of luck if you don't have the euro as your home currency. And to my Croatian friends which just got the euro this year, I already reached out to Trade Republic about it, so hopefully Croatia will be added next year. And second, while your cash is protected up to 100,000 euros by a bank deposit guarantee in Germany or Ireland if you happen to receive an account number from Citibank, you only receive 4% interest per year on up to 50,000 uninvested euros. So if you have 60,000 euros sitting on your account, for example, then the 10,000 in excess of the 50,000 limit won't earn any interest. But don't worry, you can always move those into bonds or money market funds, which we'll look at next. By the way, if you're enjoying the video so far, don't forget to gently tap the like button and to subscribe if you haven't yet. Also, if you'd like to support me and check out the brokers I mentioned in the video, feel free to use my links in the description below. Next, let's talk about money market funds. These tend to be closely aligned to the short-term rate offered by central banks and invest into short-term government debt and other fixed income securities with excellent ratings to achieve that. Here the priority is to preserve the capital that's invested, therefore to keep risk as low as possible, while offering high liquidity so that you can move your money in and out whenever you need. Basically, this should give you the current short-term interest rate set by central banks without you needing to jump from one bank offer to the next as these change. And since the current euro short-term rate is at 3.9% per year right now, these can be a great alternative or addition to high yield savings accounts. For example, if you're over the 50k limit on Trade Republic, or if you have no way of accessing the broker in the first place if your country is not supported. Not only that, when you buy a money market ETF using a reputable broker, your shares fully belong to you and can't be touched in case your broker or bank were to go bankrupt for whatever reason, no matter if you have 100,000 or €1 million invested in these. That's a major difference to high yield savings accounts, which are usually only secured up to 100,000 euros via a bank deposit guarantee. As for the best money market ETFs right now, I would personally take a look at the largest money market fund in Europe, the xTrackers Euro Overnight Rate ETF, if you're looking to earn interest on your euros. It tracks the performance of a deposit earning interest at the euro short-term rate very closely, and while the replication method is swap-based, which can introduce a bit of counterparty risk, it is well collateralized mostly by low-risk government bonds with good ratings. Therefore, it carries very little risk and should have a similar safety profile to bank deposits. You can find it with the ticker symbol XEON using both Interactive Brokers and Trade Republic, linked down below. Just keep in mind that if you happen to be in a negative interest rate environment again in a few years, it won't make much sense to hold money market funds anymore, as your shares would start losing value on a yearly basis. However, until that's the case, money market ETFs like the one I mentioned are a great low-risk option to earn interest on your money at the current ECB rate. And who knows, maybe we'll never see negative rates again. If you're looking to collect the short-term rate on US dollars, which is a bit higher at over 5% right now, you could take a look at the Lyxor Smart Overnight Return USD ETF. It is a secured swap ETF as well, in this case collateralized by about 104% of its value in stocks. You can find it using the ticker symbol SMTC on Interactive Brokers directly in US dollars, SMARTU if you want to buy it in euros, or once again by searching for the ticker SMTC on Trade Republic. But please don't be blinded by the higher interest rate that's offered in the US on dollars, which you're trying to capture with this ETF. Here you're exposed to exchange rate risk, so if the euro gains value against the dollar, you could actually end up losing money in euros instead of seeing your money grow. Of course, the opposite could also happen. The dollar could gain value against the euro during your holding period, in which case your shares could grow in value in addition to the higher short-term rate that's offered in US dollars right now. But it's a bit of a gamble, so I would stick to the xTrackers Euro Overnight Rate ETF personally. Okay, let's talk about bonds next, starting with bond ETFs, which for a long time have been the only way to easily access this market as a private investor. Here we're once again going to focus on bonds in euros, since we want to avoid exchange rate risk when looking for a safe place to park our money. Looking at just ETF, the two largest euro-denominated bond ETFs with an investment grade rating are the iShares EUR Corporate Bond with over 12 billion euros in assets under management and the iShares Euro Government Bond ETF with over 4 billion euros. And now let me show you why I'm generally not a fan of covering bonds via ETFs. Here's how they performed over the past 3 years. The government bond fund was down as much as 22% at one point and is now sitting at minus 19%, while the corporate bond fund performed slightly better at close to minus 11%. This is not something you want to see in what is supposed to be the safe, stable portion of your investment portfolio. Meanwhile, here's how a global stock market ETF, the Vanguard FTSE All-World, held up in comparison throughout this difficult 3-year period. This is because bond ETFs expose you to duration risk since they tend to include bonds with longer durations. For example, a Euro Government Bond ETF by iShares contains average maturities of 8.6 years. As a result, these older bonds become less attractive and lose value when interest rates rise for newly emitted bonds, which is exactly what we've seen since 2022. Now, since inflation has come down a lot over the past few months, which was the primary reason for the ECB to raise rates, we may as well have reached the top as far as interest rates go. This means a decrease rather than an increase in rates is becoming more and more likely in 2024. If that happens, these bond ETFs will become more valuable again, which could be an opportunity to generate extra returns. However, this is a bet on rates in the future, and in my opinion, you should not be placing bets with the low-risk portion of your portfolio. As a result, bond ETFs remain a suboptimal way to cover this asset class in my opinion. There may be one exception, however, which was recently launched. I'm talking about iBonds, innovative new corporate bond ETFs which were recently launched by iShares. What makes these special is that they have a specific maturity date between December 2025 to 2028, depending on which one you choose. Let's pick the largest one ending in December 2026 to see how it works. Just ETF explains it pretty well. The index does not reflect a constant maturity range, as is the case with most other bond indices, whereas one 5-year bond runs out, for example, it will be replaced with another 5-year bond and so on, with the ETF running indefinitely. Instead, only bonds that mature during the designated year, here 2026, are included in the index. The iBond ETF will be closed at a fixed date, in this case December 2026, at which point investors will have their money paid out to their brokerage account, which could then be used for another iBond ETF with a different maturity date and so on. Its main advantage is that it has a fixed ending date and that before buying it, you can see its average yield to maturity on BlackRock's website on a given date, in this case 4%. That's what you can expect to earn per year by holding it until it is closed, as long as you don't sell your shares earlier, since it could still fluctuate in value based on interest rate changes in the market. Thus, iBonds could be an interesting new option to earn interest on your hard-earned cash with low risk, as long as you're willing to hold them until their closing date. The one downside in my opinion is that they contain a large percentage of bonds from companies in the banking sector, and that generally speaking corporate bonds still tend to carry slightly more risk compared to bonds issued by governments with good ratings. But then again, maybe I'm biased due to everything that happened in the banking sector this year. Speaking of Euro government bonds as a safer alternative, there's finally an easy way to access these directly via fractional bonds on Trade Republic, starting from only €1 instead of needing to invest a minimum of 1,000 euros as is usually the case. Fees for buying and selling are also limited to €1 no matter the amount you invest. And before you ask, you are indeed investing to real fractional shares here, not derivatives, and you retain full ownership of your fractions, which are held in segregated accounts at their custodian bank HSBC, just like full shares are. Thus, your investments are fully protected and can't be touched, even if the broker were to ever go bankrupt. I went more in depth on fractional shares 1.5 months ago, when I also invested €500 into a bond myself, a short-term Spanish government bond with a yield of 3.87% per year. So make sure you check out that video as well, since it contains more details on how everything works and the entire investment process. Personally, I like to stick to short-term euro government bonds issued by countries with good credit ratings to minimize risk, but you're of course free to go for other types of bonds as well. For example, picking bonds with longer durations could be a way to lock in attractive yields for an extended period of time, which could pay off in case interest rates drop again in the Eurozone in the near future. If that happens, you would most likely also be able to sell those bonds for a higher price if you so choose, but I would still always buy bonds with the assumption that you're gonna hold them until their maturity date, otherwise you're betting on future outcomes which are impossible to predict. Now, if you don't have access to Trade Republic or you want a larger number of bonds to choose from, you can use Interactive Brokers and its bond scanner under the Research tab. Here you can find both US Treasuries in US dollars, again exposing you to exchange rate risk, but likely more relevant to you, non-US sovereign bonds as well, with you being able to set the earliest and latest maturity date you're interested in, or a specific country you want to buy government bonds from. Just don't forget to set the currency to euros. During market hours, you should be able to see the respective yearly yield for you as a buyer under current ask yield. Just keep in mind that when buying bonds on Interactive Brokers, you're buying full bond units with a face value of at least €1,000 each, so you're less flexible in the exact amount of money you can invest here. Still, it could be an interesting alternative to what Trade Republic offers. It's just not as beginner friendly. And just so you know, on Interactive Brokers, the trading fee for European government bonds is 0.1%, with the minimum fee being €2. Alright, I think we covered a lot today. High yield savings accounts, money market funds, iBonds, bond ETFs, and both fractional and full bond units. Now, will you be able to build wealth long term with any of the options I mentioned today? That's unlikely. You're still better off putting your risk capital to work in the stock market via low-cost broad-based ETFs, which have historically returned 7% or more per year on average, significantly beating inflation. However, you need to be willing to hold this long term, at least 5 years, ideally 10 years or more, to give yourself the best shot at actually collecting those higher average returns, since corrections and crashes are a normal part of investing in stocks. And there are many situations in life, for example, if you're saving money to buy a house or apartment in the near future, where you want to protect your nest egg from that sort of volatility. In that scenario, you should definitely consider some of the options we discussed today, which currently enable you to earn up to 4% per year while keeping risk low. Just be mindful of a few things. If you go with a high yield savings account, make sure it's secured by a €100,000 bank deposit guarantee, like the one offered by Trade Republic. When you look at bonds, stick to Euro government bonds if possible, issued by countries with good ratings, and keep the duration risk in mind. When buying a bond or even a new iBond ETFs, you should have the intention to hold them until their maturity date, otherwise you're just speculating. As for money market funds, like the xTrackers Euro Overnight Rate ETF, which enables you to eliminate duration risk completely, make sure you buy it using reputable, strictly regulated low-cost brokers like Interactive Brokers or Trade Republic, which don't lend out your shares. You can find my links down below, by the way, if you'd like to support me. Now, if I had €100,000 in cash that I wanted to park for a few months or up to 3 years for a large upcoming purchase while keeping risk as low as possible, I would grab the 4% offered by Trade Republic up to its €50,000 limit and split the remaining €50,000 between short-term euro government bonds and the money market ETF I just mentioned. At least that would be my personal preference right now. I'm curious to know what you would do in that scenario though, so let me know in the comments. Before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. You can find the ticker symbols to the ETFs I mentioned down below in the description. Also, please keep in mind that none of what I mentioned today was of course meant as investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.